Okay, everybody, let's take a look at Chapter 12, which is on corporations. So just a brief walkthrough of the material in the chapter. Just some terminology here so that you, if it's used in the questions, you understand. A corporation is a separate entity from its owners. The owners are called shareholders. Each unit of ownership is called a share. Share capital, or sometimes called capital stock, is the general term referring to all of the corporation's shares. There are common and preferred shares, which we're going to look at further a little bit later in the chapter. A corporation can be privately held, which means its shares are not for sale to the public, or it's publicly held, which means that the shares are available to the public, and there's usually then a lot of shareholders. Some characteristics of corporations. Again, like I had mentioned, they are a separate legal entity. Limited liability of the shareholders. That just means that when you invest in a corporation, the maximum that you can lose, the maximum amount that you can lose is the amount that you have invested. Ownership rights are transferable. That just means that you can easily transfer shares, which are which represent ownership in the corporation, and it has a continuous life. It's not, the life of the corporation is not tied to the life of its owner. What else do we want to look at? Oh, this exhibit here, 12.1, is a summary of advantages and disadvantages of the corporate form of organizations. So everything we just looked at here, they're listed out. And corporate taxation. So they have all the same taxes, so property tax, payroll tax, HST, that kind of stuff, as proprietorships and partnerships, but they also have one more tax. They have income tax expense. So proprietorships and partnerships, the profits are taxed in the hands of the owners, whereas a corporation, they pay their own taxes. Okay, that is it for that section. Now we're going to go down. We're going to go down and look at organizing a corporation. So incorporation, you can incorporate under provincial laws or federal laws. It's a legal document, usually articles of incorporation, just other names for it. The corporation's charter is what authorizes the number and types or classes of shares that can be issued. Authorized shares, where is that? Here we go, authorized shares. Authorized shares are the total number of shares that a corporation is permitted to sell. So it doesn't mean that they have sold that number of shares. That's what they're allowed to sell, and then they can issue shares then. But authorized is the total number that they are allowed to sell. So once all that is done, the shareholders elect a board of directors, and the board of directors are responsible for guiding the corporation. Organization costs. So there are costs involved in setting up a corporation. They are organization costs or startup costs. So they can include lawyers' fees, promoters' fees, amounts paid to obtain your charter. So these are all costs that are expensed as they're incurred. This exhibit here, authority structure. So the shareholders are the owners. They elect the board of directors. The board of directors then has authority over the chief executive officer, the CEO, or other executive officers. And these executive officers then have authority, and they over running the employees of the organization. So you can see how the authority structure trickles down here. And right here, shareholders may delegate their voting rights to an agent by signing a document called a proxy. Shareholders here have three basic rights. So shareholders have the right to vote, the right to receive dividends once they've been declared, and the right to receive property of the corporation after its closure. So if a corporation shuts down, after everything has been paid, they get to receive property of the corporation. And something else to be aware of is when a corporation has only one class of shares, those shares are called common shares. We're going to look at common and preferred, but if there's only one class of shares, it has to be common. Okay, we'll move on to the next section. So, corporate financial statements, we'll look at the income statement. So corporations, because they are a separate legal entity, they have to pay tax, whereas a proprietorship or a partnership, the taxes are paid by the owner. A corporation is a separate legal entity, so they have to pay their own taxes. So if we look at income statements here, this is a corporation and this is a sole proprietorship. It's the same right down to the profit. But whereas a sole proprietorship would stop here because the profits are taxed in the hands of the owner, the corporation has to pay its own tax. So it's profit before tax, then there's the income tax expense to get the net profit. Statement of changes in equity. So the equity of owners, no matter what the form of the organization is, will only change for three reasons: profits or losses, distributions of profits, and owner investments. Those are the three causes of a change in equity. So for sole proprietorship, all three of these activities here are recorded in one account. It's the owner's capital account. In a corporation, they're recorded in different accounts. So profits and losses and dividends, both of those, so profits, losses, dividends, are recorded in retained earnings. While shareholders, which shareholders are the same as the owners, their investments are recorded in a share capital account. So it's either the common shares or preferred shares, depending on which type. So retained earnings, so that then represents the profit to date that has been kept by the company to reinvest into the business. And the statement of changes in equity for the corporation shows how both retained earnings and share capital have changed during the accounting period. So the same three causes would cause the equity to change. It's just sole proprietorship records it all in one. A corporation has a couple of different accounts where they record these changes. So go ahead here. This is the sole proprietorship. So we're assuming here a new business. So it started off with nothing. The owner invested $500. Profit was $60. So the total equity was $560 less withdrawal of $40. So the account null and gauge capital. It's the owner's name and his capital account. In the corporation, we have share capital and retained earnings. They total up to total equity. Again, balance starts off at zero. But instead of owner investment, here it's share capital. So there was $500 in share capital. Then profit or loss, again, it was different because of the $12 in taxes from the previous slide there. Profit or loss goes into retained earnings. And under proprietorship, the owner took out money's withdrawal. Here, they get paid their money in dividends. So that gets taken away, deducted from retained earnings. And then we get our totals. So I'm just looking to make sure I'm not missing anything that I want to tell you. Yeah, these little important tips here, make sure you read through those. They kind of summarize what we kind of look at here. And then the balance sheet. Okay, so the balance sheet, it's the same as a proprietorship, except for the equity section. The sole proprietorship it's called, the equity section is called owner's equity because it's only just the one owner. But in a corporation, the equity section is called shareholders equity. And let me scroll here. So this is the sole proprietor again. So again, the top half here is the same. We get to equity, and that's where the difference. It's equity, so under the sole proprietor, it's the owner's name and his capital account. Under the corporation, we're showing the data from up here, 500 share capital and 8 retained earnings for total equity of 508. And again, important tips, so make sure you read through those. Okay, equity financing. So the selling or issuing of shares by a corporation. That's called equity financing, because what they're doing is they're increasing their assets, generally cash, through an equity investment. So they issued shares in exchange for $100,000 in cash. So through an equity investment, they've increased their assets. So it's called equity financing. Accounting for shares. Again, this kind of stuff here is just more background, and so that you know the terminology. So corporations can sell their shares directly. That's usually done when it's a private corporation, or they can sell their shares indirectly. And that's usually when it's a public corporation, and there they would use a brokerage house or an investment bank or someone to sell the shares for them. Market value per share is the price at which a share is bought and sold. So that's determined on the market. Important here, we must remember that the buying and selling of shares between investors does not impact a corporation's equity accounts. It only impacts our equity accounts when we're issuing shares ourselves, but when they get sold between various people, it doesn't impact us or the corporation. Common shares. Okay, so if there's only one class of shares, then those need to be common shares. So common shares, here it is, residual equity. So they represent residual equity, which means what is left over after the creditors and all the other shareholders are paid if the corporation shuts down. So all of the creditors would be paid first. If there's other shareholders, which would be preferred shareholders, for example, if they get paid first, and then when all that's said and done, if there's anything left, it goes to common shareholders. Issuing common shares. Okay. So shares are most commonly issued for cash. So here, June 4th. So they were granted a charter to issue an unlimited number of common and preferred shares. They go ahead and they issue 30,000 common shares for $300,000. So they receive $300,000, so we debit cash and we credit common shares $300,000. Then this exhibit here, 12.6, they show then how this would look in the equity section of the balance sheet. So common shares, unlimited shares authorized. So authorized here, that means that's the number of shares that they're allowed to issue. That doesn't mean they've issued them. It just means they can issue as many as they want, unlimited shares. 30,000 shares issued and outstanding. So that's what they sold up here. So this refers to the number of shares and how many have been given out or sold. So we're referring to the transaction up above. That was for $300,000, and that's here the dollar amount of the shares. Retained earnings, this is the accumulated profit or loss of the business, less any dividends that were paid out. And they tell us here that we're assuming a profit of $65,000 and no dividends. So that 65 then goes into the profit, goes into retained earnings, which then we total up and get our total equity. Okay, I think I've mentioned everything of importance there. Sorry, I usually pause in between getting my screens ready so that I don't waste time.